We're going to start off now, so thanks Cameron for sort of covering lots of the asset classes and maybe even all of the asset classes. We're going to now start going into our panel sessions and looking at each separate asset class. So we're starting off with Aussie equities. As we close out reporting season and consider how resilient our portfolios are to rising interest rates, the energy transition or technology, we're joined by Andrew Garrett, David Wunnis, Peter Bell and Hamish Tadgell. We'll come up in a moment. Andrew joins us today as Investment Director at Perpetual, where he works with Perpetual Private's clients and with advisors on investments processes and strategy implementation. He holds an Alternative Investment Analyst Charter and is a proud CFA Charter holder as well. David Wunnis is the co-founding partner and the Chief Investment Officer and the Managing Director at Longwave Capital Partners. So he's either great at multitasking or rubbish at delegating. His background is in small caps in particular, both in his role at Longwave but also in prior roles at Schroders. Peter Bell is also a co-founder, but in his case at Belmont Securities. He's a passionate value investor and as such he'll find any chance, whether relevant or not, to drop in a Warren Buffett quote, so listen out for those. As well as running the Belmont Classic Value portfolio, Peter consults to a large number of high net worth and sophisticated investors and runs a 400-member high net worth investors value network. It's kind of like Tinder for Charlie Munger fans. And Hamish is a portfolio manager at SG Hiscock, having joined there in 2015 from Goldman Sachs, and prior to that, Arthur Anderson. He's a portfolio manager at the SGH High Conviction Fund, so expect a man who has high conviction and doesn't sit on the fence for this session. So with that fine lineup, let's kick off our next session. Thank you.
Well, good morning. So we've got a really good panel today here, some really good knowledge, and I know from our discussions that they share a lot of our own views, as in how we see things at Perpetual. The topic is pretty critical, and I know we've all debated it in many ways, and that is, are markets too optimistic, specifically around Australian shares? Now, I don't want to take too much time away from the panel discussion because I really want to dig into that, and I think it's worthwhile doing that. However, I did want to just set the scene a little bit and give a little bit of context about some of the key themes and key factors that are driving the scenario or the landscape of today's equity markets. So, one of the great things about being in a room like this is 2 years ago, you probably wouldn't have believed that we'd have 100 people stuffed in a room today. It's nice to be back, but things have changed. This chart shows that the monetary landscape has dramatically altered. What it doesn't show you, because it's not long enough, is that we went through a long, stable period where interest rates are falling, and that, of course, created a tailwind for asset valuations. Of course, as we now know, that abruptly changed when inflation proved not to be transitory. Central banks had to take action, and take action they did. We've seen arguably the fastest increase in interest rates in recorded history. And of course, that has an impact on assets, not just the valuations, whether your discount rate or your multiples you're using, but it also has an impact on the underlying fundamentals of the economic agents you're investing in. The companies, for instance, your interest expense has gone up. So those highly indebted companies are facing margin squeeze as a result. Now, of course, 2022, in the face of this rapid tightening of the monetary landscape, we saw a sell-off. I mean, Australian shares actually didn't do too badly, all in all. However, most people, if you speak to them, their experience of 2022 was that it was a bad year. And, arguably most asset classes were negative on the year. Coming into this year, it was pretty consensus that I think we were going to see a recession of some sort. It was certainly, one of the key themes. And look, I know from our panelists, we're a bit bored of talking about whether it's a hard landing or a soft landing or whatever kind of landing. But what has been interesting this year is the buoyancy in markets. All the sort of doom mongering and all those sort of concerns that this was going to be another tough year haven't really played out. Now, these two charts here, The dark line is international equities. It's not our topic today, but the reason I've got that there is, of course, those magnificent seven, those AI companies. And, I guess one argument could be made that the sentiment that the success of those seven companies has bled into other areas. It's one way of looking at things. I'm not sure where we sit on that, but it's a fair argument. But the point is that markets have looked pretty good this year, despite people's views, to the extent where people are actually starting to soften those views. That the idea that we might have a recession, in most people's views, has gone down. Now, I know, particularly as we are all here believers in active management, sorry, but the under the surface, it's not just what's happening at an aggregate level. Under the surface, last year, for instance, or over the last year, we've seen a massive swing back to value as a style. And value's had a tough time. I too am a fan of Charlie Munger and Warren Buffett, and I'll get my quotes out if I get a chance. But, it was good to see value swing back. And the question is, does that persist, and is that a theme that's coming back in this environment? Equally, I guess potentially as a risk aversion type positioning, we've seen larger companies outperform. That sort of stick with safety, stick with the bigger names, has been a bit of a thematic that started to emerge. And again, the question is, is there joy to be found? Are there opportunities to be found within small caps again? And does that pendulum swing back? One thing that we do know, and we've just cleared reporting season here in Australia, is PE multiples have expanded. So it definitely suggests that market participants are looking more optimistically towards the future. It does suggest that a recession, that negative growth environment is certainly less priced than it was earlier. But that's probably glossing over things. I guess the thing that we look at Perpetual, and think some of the key charts for us, really plays into the strength of the consumer. It does feel like the consumer is the Achilles heel at the moment. And we all know, you can't pick up a paper at the moment without hearing about how tough cost of living is. And we all anecdotally meet people that are finding mortgage payments, increasingly difficult to meet. So it's a prime environment for opportunities, but also a prime environment for risk. And that's what I'm looking forward to talking to these guys about now. I know we are effectively bottom-up by nature. However, let's start with the big question. Don't worry, it's not the economy. But at an aggregate level, do you believe that the Australian stock market, so the ASX 300 for instance, is optimistically priced?
Seeing I'm sitting next to you, I'll start off. Look, I don't think you can look at it from such a simplistic perspective. I think you can look at, if you're going to be index investing, that's an important question. For us, I think there's a wide dispersion in the optimism priced into certain sectors of the market. So from looking at the market, I would say that what we're seeing right now is we've seen a lot of fundies move to defensive exposures, large cap companies, non-cyclical businesses and so on. At the same time, we've seen really heavy sell-off in some of those unloved sectors where everyone is in full agreement that they're going to have difficulties moving forward. So we're talking about consumer discretion. We're talking about smaller companies. So I think there's a wide dispersion if you look at it in terms of how the equity market's priced. Now that may be completely appropriate if you look at the environment over the next 12 months. But I think if you're a longer term investor, and we're talking 5 years out, if you can actually look beyond everyone's short-term focus on whether there's an economic downturn in the next 12 months or so, I think it does introduce some real opportunities in that the relative valuations in different parts of the market.
Thank you. David.
I think I might have some slides here. I'll have a quick different journey from other parts of the market. So the chart to the right there is just showing you how enthusiastic things got in the small cap market in the last couple of years. So interest rates went to zero and a lot of small cap investors basically lost their minds, right? So the number of companies that earned no profits with a market cap over $100 million absolutely skyrocketed in the last couple of years, right? So the experience small cap investors have had has been quite different. And if we go here, this is just giving you an idea of what the average small cap fund investor has experienced. And what we've seen is almost 2 years of underperformance. That's the teal line in the middle there. And we're comparing that to a couple of other big drawdown experiences of small caps. And so whilst there may be questions for other parts of the market, are we too optimistic? That was a really good question for small caps 2 years ago. We think now actually a lot of people have abandoned that part of the market. We can talk a bit later on about valuations, but it actually does look like quite a good opportunity. As was just mentioned, a lot of people are hiding out in defensives and things that are making them feel safe, and small caps have been left behind. So that's just something I wanted to show, because I think visually it gives you an understanding of just how much opportunity there could be in small caps and how different small caps are to the rest of the market.
Thank you. Hamish.
So I'm not sure, is this working?
Yep.
So I think what I would say is that I agree with the comment that you can't look at the market at an overall level, because I think one of the things that has clearly come through in reporting season, and which I think is becoming more obvious to everyone, is that the economy out there is very uneven at the moment. And there's some sectors that are prospering, and there's some sectors that are doing it tough. Some households are doing it tough, and there's some cohorts out there that are much better positioned and from a financial perspective. And that's feeding through into how the economy is performing at different speeds, multiple speeds in the economy, and there's also multiple or different performance that you're seeing across sectors and across stocks. Now, some of this is cyclical, but I'd argue also some of it's driven by structural changes that are going on. So things like the digitisation, I think, is an undeniable theme, and again through reporting season we've seen strong evidence of that in a number of stocks names. The energy transition, another theme that I think is sort of undeniable, and there are ways that which you can play that through the market, which we can talk about a bit further. But I think it needs to be stock and sector specific, but also accounting of the sort of the unbalance that's going on in the economy at the moment more broadly.
Well, Hamish, since you've touched on it, and it is a very sort of topical point, we might as well go through sort of key themes that we're seeing and opportunities, and the electrification and the reduction of carbon is a key one. So as you've started that, why don't you expand on that a little bit?
Yeah, well, I think it's just a couple of observations I'd make. So if you look, digitisation is one theme that I think is undeniable, but I think there's clearly been a lot of chatter around AI, and I must say every company that comes in and talks to us at the moment talks about benefits of AI, and I'm a little bit more sceptical around it. I think AI will potentially provide some benefits initially, but every company's going to have a bot, every company's going to be using AI at some point. And I think if you go back and think about Excel, people thought Excel was going to be a great productivity tool initially and help, and it's ubiquitous now. It's actually a cost of doing business rather than, and I think AI long term will sort of be like that. Now there's going to be some beneficiaries, clearly those that provide the hardware, the data centres and the like. Another area which I think is interesting around the sort of the digitisation is just the take-up of cloud is still relatively underpenetrated. So AWS says that 10 to 15% of enterprises have migrated to the cloud. Now there's some that have migrated fully, but there's still a long way to go. And I think it's interesting, NextDC just in the last 2 quarters have doubled the size of the hyperscale contracts that they've done relative to the lifetime of the business. So the business has been going 13 years. In the last 2 years, they've doubled the size. And it just, I think, shows that there's this real post-COVID, companies are thinking differently about how they're using technology, more work from home and all those types of trends, which is driving changes in digital behaviour like we've never seen before. I might stop there and let others talk about some of the other themes.
Yeah, David, I guess small caps, is that?
Yeah. So a couple of things. I won't go back to the slides. There was one on there. Interest expense, interest costs, balance sheets. I know it's boring, but it's coming right to the fore now. We all talked about the mortgage cliff, fixed rates, resetting to variable, what that would do to the consumer. What we're seeing in the consumer is not yet having as big an impact as people expected. But what was interesting in reporting season was that people kind of forgot that a lot of corporates had fixed their debts at really low levels as well. And none of that came through last year in terms of fiscal 22. And fiscal 23, in small caps at least, we saw a 33% jump in interest expense. And it was much higher than people expected. And it's flowing through into forecasts for next year. So, balance sheets do matter. And I think we got a bit complacent about financial strength. And we heard earlier about quality companies tend to have better balance sheets. So that's one area we focus on. The second thing, and again, Hamish touched on it, is what's happening at the company level can often overwhelm what's happening at the macro level. So we see time and again in the same sector, big winners and losers, and often the difference is how well those companies are executing. So we saw in building materials, for example, Boral's earnings expectations have gone up 48% this year. Fletcher Building's down 25%. And they largely operate in similar parts of the economy, and the difference is management execution. And so as we go through every reporting season, really what we're looking for is that management scorecard of how well these companies are executing and not getting too caught up in the macro top-down view of you need to be in staples or healthcare or cyclicals, because you can be massively overwhelmed as an investor by just how well the companies execute inside their sector. So that would probably be the couple for me.
Isn't it nice that fundamentals are important again? Peter.
Yeah, look, I would stress once again, we're very much bottom-up investors. So we really don't try and predict what themes and what themes are going to be driving markets. What we tend to have a really strong focus on is management. And investing in businesses with management where they've got a proven track record of identifying some of these themes and how they can take advantage of them in their own business. We've got a really strong focus on founder-led businesses. And when we're talking about businesses where the founder has built this business from zero to the point where they're A, listed on the stock market, and B, where they've delivered the sorts of profitability, stability and growth that means they pass all our quality screens, they have been able to position themselves appropriately for many of these big macro trends for a long period of time. So we're putting a lot of faith in that capability of management to continue to position their business to benefit from some of those big macro trends that are occurring. So that's how we prefer to do it. One thing I would say, though, in terms of those macro trends, we're still seeing, interestingly, a little bit of a COVID recovery play that still hasn't played out. So there are a number of sectors where companies got absolutely hammered in COVID, and we can see that recovery coming back through. And yet it's still far from fully priced by the market. A perfect example is travel. Corporate travel management is one of our large holdings, and they have gained massive market share over the last few years. They've absolutely come out of COVID a much, much stronger business than they were going in. And yet you're still seeing the share price substantially below where they were pre-COVID. It's a really, really high quality business with an ongoing tailwind as the corporate travel sector returns. And yet that's really not being priced in by the market. So that's one interesting thematic that we've picked up in recent times that's worth taking a bit of note of.
Excellent. Now, we recently speculated that potentially central bankers and fiscal policy had been too successful in the sense that it had emboldened consumers, it had reduced the sense of risk aversion that consumers and indeed some investors are feeling. So Hamish, I know you and I have spoken about the behavioural aspects of things that have changed within the market. What are you seeing as behavioural themes that have changed the investment landscape?
Yeah, I think one that David sort of referred to earlier was just around valuation. I think one of the things that investors have really struggled with over the last sort of few years is what is the cost of capital, what's the equity risk premium, and what's the risk-free rate. And they're clearly all important inputs into discounted cash flows. And I must say, we've been increasingly, well, I've always been, I guess, sceptical around discounted cash flows from the perspective I think it's a very good discipline, but in terms of forecasting cash flows for businesses, but I think what those inputs are, and particularly what the terminal growth rate is, which is another, has been really brought into question. And so I think it's caused quite a disconnect in how people think about valuations for businesses. And back to David's point before, the enthusiasm around revenue multiples and that sort of thing has come back to bite, because we've seen that there is no free lunch now. Companies are not able to tap the market in the same way they were even 12, 18 months ago. Now you're having to conserve cash, manage your balance sheet, manage your capital structure in a much more disciplined way. Because, as I say, the ability to raise capital has become much, much harder. So I think it's a behavioural change which I think the market is still sort of adjusting to and investors are still adjusting to, but I think it's a really important one.
Yeah, I think the behavioural aspects of investing, and Cameron showed some charts earlier about that behaviour gap for the underlying investor. The longer I'm in markets, the more I feel that the behavioural elements are so much more important than the sort of academic elements of how markets are priced. I was fortunate enough in some ways to have a front row seat to the tech bubble. I sort of worked for the queen of the internet, Mary Meeker, when I was at Morgan Stanley back then. And I never thought I'd see it again in terms of the this time is different, forget all of your first principles investment thinking that went on in sort of 99, 2000, 2001. But we saw it. We saw it 2 years ago after COVID when interest rates went to zero and crazy stuff happened in markets. And you couldn't get a spreadsheet, you couldn't get a DCF to make sense of any of this stuff, but it was how the world was going to be, and things got crazy. And now we're coming back to reality. And so in many ways, the behavioural temptations or fears that we have are often the biggest thing that sits between us and successful investing, because I'm sure we'll hopefully get some Warren Buffett quotes, but we know, he's told us for 50 years what to do, right? He's sort of laid it out really clearly. It's the doing it bit that's really hard, and that's the human behaviour. And to me, that drives a lot of what we see in markets. And as a professional investor, the idea is to try and remove yourself from that and not get sucked into environments where you can lose a lot of your clients' money if you sort of get carried away.
Yeah, that suspension of disbelief is somewhat over. It's nice that things are getting back to it's no longer growth at any cost, buy every dip.
No, completely agree. And one of the behavioural aspects that I've seen is, I think, increasing short-termism in the market. I think everyone is so fixated on what is going to happen in the economic environment in the next 12 months. And we've spoken so much about Buffett quotes. One of his classics is, put together a portfolio of assets whose aggregate earnings march steadily higher over time. So too will the portfolio's value. Now, I think a lot of that gets thrown out the window when we're talking, when we're fixating so much on what's going to be happening to the economy in the next 6 and 12 months. You've got companies like Woolworths, which, yes, it's defensive, but its earnings have gone nowhere for a decade or more. It's trading at 28 times earnings. You've got retail companies that are still growing their earnings strongly in this current environment, may well have some difficulties in the next 12 or 18 months, that are trading on single-digit multiples. Now, does that make sense in the next 12 months? Possibly. Does it make sense for the generation of increased earnings from your aggregate portfolio over the next 5 and 10 years? Absolutely not. So I think that short-termism, trying to predict the unpredictable, Howard Marks has a saying, for something to be important, it has to be, for something to be worth focusing on, it has to be important and knowable. What the economy is going to do in the next 12 months is important, it's not knowable. So focus on what you can know and that's investing in good businesses where their earnings are going to be substantially higher in 5 and 10 years' time, and buy them at a reasonable price. Stick to the fundamentals.
What a great way to open for questions. Thank you.
Yeah, okay, look, if I can start, 3 things you have not mentioned, E, S and G. I'm just wondering, I mean, you talked about how value came back last year and a lot of that was energy. And, you know, we're reading in the press how the big super funds are under pressure for owning Woodside, Santos, etc. 2 questions, I guess. One, how much attention do you guys pay to ESG in your stock selection, portfolio construction? And secondly, how big a factor do you think it's going to be in driving the market when it, you know, things like don't buy oil and gas, etc.?
Look, I'll start, and I'll start, and I'll start by saying the biggest problem is that your ESG is not my ESG. The factors that you are concerned about might not be the same factors that I'm concerned about. They might not be the same factors that some of your clients are concerned about. Very, very difficult to put together a portfolio that meets everybody's ESG concerns. We actually think managed accounts are an incredibly powerful vehicle for managing ESG concerns because you can have exclusions and substitutions in the portfolio on a one-on-one, case-by-case basis with your particular client. So we don't try to apply that lens ourselves in the portfolio. We try and deliver the best portfolio, generating the best long-term returns. For those clients who have strong views about particular companies, they may not want any oil and gas exposure. With any of the platforms that we're on, we're big users of Hub24, they can actually exclude those securities from their portfolios and replace them with something else if they choose to, or allocate it across the rest of the portfolio. We think that's the best way to deal with ESG. We think doing anything else, a one-size-fits-all policy just doesn't work, and it's going to actually hamstring your returns and therefore cost most other investors, and we don't think that's appropriate.
I don't have a lot to add there. I think it is the individual client choice. Managers need to be transparent with what they're doing so that the clients can make an informed choice about whether each manager is appropriate for what they're trying to achieve.
I agree too. I mean, the way we think about ESG really is, you know, how companies are managing 21st century business risks. And you know, that comes back to really the quality of the management and how they're dealing with those issues. The other point I'd just make is that I think there's been, over time, a lot of focus on the E and the G. And through COVID, I think there has been a lot more focus brought to the S and the importance of that. If you think about employee, the S really incorporating, you know, stakeholder engagement, employee, customers, all those issues, they've been front and centre through COVID. As we've worked from home, as we've had challenges working with supply chains. And I think a lot of issues that companies are facing are really around that S issue, and probably no better example than sort of, you know, Qantas at the moment and how it's dealt with its customers, and how it's dealt with its employees, and how it's dealt with stakeholders more generally. So that social licence to operate, which I guess it was brought to the fore, you know, with the banking inquiry and so forth, but we're seeing it play out in so many other sectors at the moment. And it's the soft intangible, it's not the financial, but it does go to the heart of the value of the business, because, you know, it affects the equity, effectively the beta, or the equity premium in the business, and it's really important to focus on. So we spend a lot of time thinking about it, and we think about how it's going to impact upon the longer term value of businesses if you don't look after your key stakeholders, but also, you know, being customers, employees, etc.
I think that's a good point. I was in the UK during the global financial crisis, and I can tell you that the British banking sector lost their social mandate. And so British banks severely underperformed for the following five to 7 years.
Other questions? I guess I have a question which was touched on through this session, which is the sort of intersecting forces of recession and and interest rates, and how you see them impacting on overall, that sort of intersection of forces impacting on the overall market.
I'll start by saying that's not something we spend a lot of time on, simply because it was only, 9 months ago, economists came out and said the probability of a recession, I think it was in the US, is 100%, right? How can you give a forecast with a probability of 100% of something that hasn't happened yet? But we see it all the time, right? The number of head fakes that we see as investors, we'd end up with 50% cash before we knew it, because every time we sort of get a scare from something in the economy, we'd sell. And
500% turnover.
Yeah, that's right. We think about our clients are investing in our funds for a 5 to 7 year horizon. We're trying to invest in high quality businesses that can manage through a lot of adversity through time. And we've seen the last few years, a lot of companies have been through some pretty tough environments, pretty unusual environments with COVID and other things. And so quality businesses with good management teams will kind of persevere and prevail by the end of that. Us as managers trying to forecast what's going to happen, and then who we should buy and sell and how we should position, and then change that every 6 months. I've not seen many funds with great long-term track records that do that, right? The best funds with the best long-term track records, and taking Cameron's point that it's hard, right? The odds are stacked against the active manager. They tend to be the managers that focus on the businesses, not the managers that are in sort of putting macro views into a portfolio. So that's why we don't tend to spend a lot of time trying to figure out what the economy is going to do, and then how we implement.
Yeah, I completely agree with everything that was said there. And what I would point out is that we know that we can't predict when a downturn is going to happen. The 100% certainty forecast we can have is that a downturn will happen at some point. We don't know when, and we're not going to predict it. So what we need to do is construct a portfolio that will not only survive through that inevitable downturn, but will actually come out stronger. And that's investing in quality businesses. It's investing with management team with skin in the game, with a track record of delivering, with a long-term investment horizon. If we do all those sort of things, then the downturn actually strengthens your aggregate competitive position, and you're going to come out significantly strong on the other side. So once again, focus on what you can actually do something about, and that's the quality of the businesses and the management in your portfolio, rather than trying to predict what's going to happen in the economy.
Sounds like we're in furious agreement. The one thing I might just add is that all the geopolitics, politics, and everything that's going on at the moment, it's clearly leading to a high level of volatility, as was discussed earlier, and sharper movements in markets and cycles. And I guess one of the things that we think the best strategy of riding through that is to invest in quality businesses. But one of the things and conversations we're always having with clients is that you might see a little bit more volatility in the share prices of some of the stocks through that period. But over the longer term, if you invest in those quality businesses that continue to grow, you should see good long-term returns. And it's about staying the course, I think, as much as anything else through these more volatile times, and not being, sucked into the FOMO or the latest and greatest trend, but really looking at the fundamentals, making sure that it stacks up from a management perspective, business perspective, and evaluation perspective.
Great. Thank you very much. Great way to finish. Cheers, guys.
Thanks, guys.